So friends, today now we are starting our this program, deliberations on introduction to risk in banks. During this webinar, we shall be deliberating upon what is the introduction. We give the introduction to the risk, type of risk, and overview, process of risk management. Let us start our deliberations with this reality of life. All of life is a management of risk, not its elimination. So we cannot totally eliminate risk from our life. At best, we can manage the risk. How efficiently we manage the risk, it depends upon our capabilities. So now coming to the concept of risk. First, so friends, when we talk about risk, the first connotation that we have in mind is, please mute yourself, everyone. So first our connotation which will come to our mind is there is some harm, some hazard. You know, there is something negative that's going on, that's going to harm me. So let us say I go out and I want to take a car out and drive. So there is a harm, there is a hazard, the time we may meet and with an accident. Then there is something, some kind of uncertainty or some kind of possibility. Now we don't know, it may happen, so it may or it may not happen, right? So there is some kind of uncertainty which may or may not happen. It is not certain that this particular event which will cause me harm or hazard will happen. So then there is always an adverse outcome of the loss to it. So anything which is adverse, something that happens better than an expectation is not risk. Something that is worse off, that puts you in a worse situation, and that is a risk. It is always talked about the future. Why? Because past is known, the present is known. We can't do anything about the past. The present is known to us. We are talking about the future. That is what is uncertain. And because it is uncertain, there is a chance, there is a possibility that there may be a risk of loss. And of course, there is a variance between the expected and actual harm. So there is some benchmark. What I thought will happen and what actually happened. When there is a variance between the two, and this variance being negative, then we are talking about risk. For example, I decide to set up a business. Now, it is the first year of the business, and I presume that I am going to have a loss of 1 lakh rupees. Now, it can be a scenario where I do have a loss of 1 lakh rupees. So, my expected and actual return, whatever I thought, matches. So, no risk. But if I have a loss of 50,000 rupees, will that be a risk? I expected 1 lakh rupees loss in the very first year, probably thinking that my break-even point will come after 5 years. My loss this year is 50,000 rupees. That is not a risk for me, because I thought it's okay. In the first year, I will have at least 1 lakh rupees loss. So it's okay. But if, for example, I incur a loss of 2 lakh rupees, now there is a variance, and this variance is negative. So there is an adverse variance. Here we talk about something called risk. So just to bring all of that together, what is the risk? Risk is a chance. Chance as a possibility of loss, a possibility of some adverse occurrence in future. Uncertainties resulting in adverse outcome, and very important, adverse in relation to what? To the planned objective, to the planned expectations. I thought about this actually happened. Therefore, I'm talking about something risky happening. I expected a market to go up. I expected my stock prices, my investment value to go up. The stock market crashed and I suffered a loss. There is a risk. So whenever what we expect and what actually happens, there is an adverse thing that is happening. That is a risk. So just to sum up again, Risk stems from uncertainty or unpredictability of the future. Volatility. Volatility. So there is not a steady income. Volatility in my potential or expected income of cash flows. For example, let us say we all are bankers and we get a fixed salary of 50,000 rupees per month. Now, every month I know that I'm going to get 50,000 rupees per month, and accordingly I plan out my expenses for the month. But let's say I'm a businessman and I'm a hotel owner in Shimla. Now it's a COVID situation. So there could be a few months where I have 1 lakh rupees per month income. There could be a few months where I have a nil income. There could be a few months where I have a 20,000 income. So what is happening here? There is a volatility. It is unsteady. It is not something which is steady income because there is a volatility in my expected potential cash flow. Therefore, there is a risk. Low risk. Low risk implies low variability in my cash flows and low upside and downside potential. So it can be both upside, it can be both downside potential. So upside, if it happens well enough, I'm pretty happy. But downside, if it happens, sad for me. High risk implies high variability in my cash flows, higher upside and downside potential. On the other hand, zero risk means no variability in my cash flows. Now, practically speaking, there is no such thing as zero risk because even if we invest in fixed deposits, we invest in government bonds where we have a fixed rate of return, there is an element of inflation that will come into play. So real return for that matter will get impacted. So if I want to say zero risk is an ideal situation, but that really does not happen. Last but not the least is the risk involves a choice and the uncertainty that the choice or decision in this. So there is always a choice attached to it. So I had two options. Let us say I probably wanted to continue in a job, or I had wanted to go for a startup. So there is always an option because I had an option, something to do with the future, and there is an uncertainty attached to it. What if it does not work out the way I expect? Therefore, there is risk. There is always a choice between the two things that you have. There is an opportunity attached to what something you forego. So this is a concept of risk. Now, let us understand in banks, how does risk come into play? A small illustration. Let's say we have a bank, ABC Bank. It accepting deposits from the public, and how it can utilize the deposits? Two ways. It gives out loans and advances. Two, it may invest 100% of the deposits that may come. But generally, banks do not give 100% of the deposits in loan and advance. A part of it is invested in the market instruments like SLR, CRR, other securities. So our deposits becomes our liabilities. Loans becomes our assets. And now let us say what happens is large number of depositors start withdrawing money. Let's say there is a new bank. Let's say RBL Bank comes into play, and on its saving bank, it offers a 7% interest rate, just assuming a hypothetical situation. So all the depositors, especially the wholesale depositors, the bigger ones, the corporate houses, so all those who are depositing the money with ABC Bank will start withdrawing the money from here and going to RBL Bank. Or it can be a situation, there can be a situation where, let us say, there is something like negative news about the bank. Some negative news about the bank and the people panic and they start withdrawing their deposits from here and going and putting their money outside. So there is some negative news about ABC Bank. Now, when depositors come and ask for money, the people are withdrawing deposits from there and going and putting their money outside. So there is some negative news about ABC Bank. Now, when depositors come and ask for money, the bank cannot refuse. These are called unanticipated, unexpected, sudden runoff the bank. So another term which is often used is runoff on the bank. Please remember this term, runoff on the bank, or you can say run on the bank. Run on the bank means sudden, unanticipated withdrawal of deposits which the bank did not expect. So a major portion of your deposits are being withdrawn. So that is known as runoff on the bank. On the other hand, what if? So we have given out loans and advances. Now let us say I give loans and advances to Indigo, and the word of Indigo and the full form of Indigo is Interglobe Aviation. That is a company name. I give funds to the airline industry. You know the COVID situation. So airlines were really suffering. They were having a lot of losses because there was a problem with the travel industry, tourism industry. So the airlines were the real sufferer here. And let us say, I lent significant portion of my loans to real estate industry. Now the customers in these industries start defaulting. So here the money which was to come did not come. So because there was significant default of major customers, a major chunk of my loans, they were starting defaulting the money that was to be repaid on certain due dates has stopped coming. So my income stopped coming. Here I have many depositors standing on the door of my bank asking their deposits back, premature withdrawal of their fixed deposits, taking their current accounts, any kind of deposits, so on and so on. They have, on one hand, I have to make cash flows for these depositors. On the other hand, the money which was supposed to come has stopped coming. Third, what if the bank had invested in some kind of stocks like tourism or real estate, which again there was a fall in the market value? Because there is a fall in the market value, there is a stock market crash or something, value of my investment starts going down. So my investments were expected to fetch certain value. This did not fetch that kind of value. So the value of my investment declined. So if I need to sum up 3 words, what is this ABC Bank facing today? On the loans and advances, credit risk. On the market instruments, market risk. And here the cash flows which were supposed to come in did not come. So the ABC Bank is facing something called cash crunch. And in simple words, in the parlance of risk management, it is called liquidity risk. So this is what in short is about risk in banks. Friends, risk is an integral part of banking sector. And due to uncertainty and unpredictability of the financial market, banks face risk which may cause losses or reduce income. We now deep dive into each one of these risks. So if I need to classify risk, okay, broadly speaking, there are financial risks, there are non-financial risks. Both financial and non-financial risks do have an impact on the bottom line of the bank, on the profitability of the bank. But the source from where you know this risk is coming from, that may be either a financial source or it could be a non-financial source. No, it is not very clear-cut classification. So some people take operational risk also as a financial risk. It depends. But primarily, credit risk, market risk, liquidity risk are called financial risk. Whereas operational risk, any kind of compliance risk, reputational risk, strategic risk, they are known as non-financial risk. And so financial risk, every bank is very, very careful about. But between 2011 and 2017, the total amount of non-financial risk losses amounted to almost 500 billion euro. So that is something that is equally important to non-financial risk, because the downside there is pretty large. Now, within the financial risk, the first and the foremost is your credit risk. We all know, we are all bankers, that 60% of bank's balance sheet is made up of our loans and advances. Pick up any balance sheet, it will be between 60 to 70%. So because almost 60 to 70% of a bank's balance sheet is made up of loans and advances, the biggest risk that the bank faces is credit risk. Credit risk was the first risk that the Basel addressed. All other risks came later. So credit risk, everybody identified, everybody recognized, yes, it's a huge risk, and therefore it was addressed first. But what is credit risk? It is the possibility of loss. Possibility क्यों? Because it may happen or it may not happen. जरूरी नहीं है, it will happen. Loss resulting from borrower's failure to repay a loan contractual obligation. So two very important aspects are there. Loan has to be paid in full and it should be paid timely. Full and timely. There is a risk of default on debt. So after taking the loan from the bank, the customer may fail to repay. And this probability of loss arises from credit transaction. Now, how do we measure credit risk? So two ways to measure credit risk. One is your credit rating. So usually banks rely upon external credit. The second is your ratios. Certain ratios tell about asset quality. Now, before I move further into what exactly this is, credit rating measures the credit worthiness of the borrower. So whether it is Malaya, whether it is Nirav Modi, everybody was rating. What are we checking there? What banks want at the end of the day? Whatever money I have lent, come back to me in full and on time. So credit worthiness, when I say the word credit worthiness, credit rating agencies or we banker mean by that are two things. The ability plus the willingness to pay the debt. Ability and willingness to pay the debt. Ability to pay, क्षमता होनी चाहिए, and willingness, whether he is willing to pay that debt or not. So it may be there, that's a business. When I lent, the business was doing well because of, let us say, COVID situation. The business is shut down. So it does not have the ability to pay the debt now because there have been losses. One is this. The second is, he has the ability, he has the money, but the willingness is not there. When the willingness is not there, we classify the borrower a willful defaulter. Now in case of Malaya, Vijay Malaya, there is one of the major things that he has been identified as a willful defaulter because he had the money, but his personal wealth was not attached. He was still living a life of luxury, yet he is not paying his salaries to the employees. He has defaulted to the banks. Banks could not attach the properties. There was no collateral property per se with the banks. They were all junk, defunct things, some helicopters and all, which were taken as collateral property. So what credit rating companies they are measuring? The ability and willingness of the credit worthiness of the borrower. So if there is a downgrade in this rating, which means credit worthiness of the borrower has declined. Now, credit risk is also measured by ratio. So the most popular ratio, if we ever study and we talk about this gross NPA ratio and net NPA ratio, what banks do? They can set up guardrails. So they are setting up the guardrails. What are guardrails? So they always talk about concentration risk. A lot of bad banks or bad bank that has happened. A lot of bank failure that have happened is because a significant portion of loans and advances were given to a particular group, particular borrower, particular industry. So now every bank in the credit policy clearly defines guardrails. That's okay. For a maximum, single person borrower limit should not exceed 10% of the total advances. Maximum good exposure limit should not exceed 20% of the total advances. Maximum industry exposure, so let us say iron and steel, should not be this much. To real estate, to infrastructure should not be this much. So and so. For also in terms of rating, you will not give incremental exposure to accounts rated BB and below. Or a maximum exposure to BBB and below should be this much. So what are these banks setting? They are setting some guardrails. A lot of many times have been seen like this. For example, in Malvinder Shivendra case of Religare, where small banks have given a significant portion of their loans and advances to one particular group of borrower, a single borrower, and that has led to the default. Now the second one is your market risk or systematic risk or price risk. So what is market risk? Market risk and the type of financial risk. It is the potential loss on the financial investment due to adverse price movements or any of the market instruments. So what could be the various market instruments? It could be interest rate, it could be currency, it could be stock price, any investment that the bank has made, equity price risk or commodity risk. Now banks are not allowed to trade in commodity. So commodity price risk does not come into play. So any risk of loss in our on and off balance sheet. So every bank, just like any other companies, every bank has on balance sheet items, some off balance sheet items. For letter of credit and bank guarantee that the bank may have issued on behalf of client or borrower. These are off balance sheet items. So risk of loss in on and off balance sheet items. Risk position arising from movements in the market prices lead to market risk. The sources could be investment in commercial paper, corporate bonds, government securities, any open forex position. It can also lead to a market risk. So what RBI does? RBI sets limit. Maximum open forex position should not exceed so much. So that's what RBI says. You keep a limit on your forex losses. So now this kind of market risk is called systematic risk. So also called price risk because it impacts the entire market. So it is not a particular class of stock or investment. It will impact the entire market class. So it is beyond the sectors, beyond our control. That's why this is called systematic risk. Now, within the market risk, there we have interest rate risk. What is interest rate risk? So any change in the value of assets or liabilities, which is interest bearing. Any change in our value of assets or liabilities, which is interest bearing. If there is a change in the interest sensitive assets and rate sensitive liabilities. For example, current account. No interest is paid on current account. it is not a rate sensitive liability. For example, fixed assets. Fixed assets in the bank's balance sheet, it is not rate sensitive. So any asset or liability which is interest bearing, which is rate sensitive, wherever there is a change in the interest rate, it may give an adverse impact on our NII, net interest income, or an adverse impact on the value of our assets and liabilities. Then it is known as interest rate risk. Now, how do we measure interest rate risk? There is something called traditional gap analysis, traditional duration analysis. So interest rate risk, when it impacts clearly your NII on the profit and loss, P&L account, it impacts your net interest income, and on the balance sheet, it impacts your market value of equity, which is nothing but the net worth of the bank. Net worth is nothing but the present value of your assets. Again, rate sensitive assets minus present value of your liability. So assets minus liability, whenever there is a change in the interest rate, one, it will hit your net interest income, and second, it will hit the value of your assets and liabilities or your net worth. So whenever we talk about interest rate risk, because there have been fluctuations, the inflow and outflow gets impacted. An example of this, we can just say, for example, let us say that we have rate sensitive assets and we have rate sensitive liabilities here. Now, let us say that one of the interest rate increase here, rate sensitive assets are more than my rate sensitive liabilities. Let us say I am earning 10% interest on loans and advances. I have 100 crore, let us say, deposits, and 100 crore deposits have been invested to give 100 crore of loan. These loans are, let us say, at fixed rate of interest. Loans are at a fixed rate of interest. So it is at 10% interest. However, these liabilities are, our deposits are on our floating rate of interest. And I have probably given out something like 8% on these my deposits. So the NII of the bank is what? 10% minus 8%, 2%. Now, assuming that the interest rate increased by 1%. Now, my 100 crore of loans were at fixed rate of interest. So I continue to earn 10%, but my liabilities, 100 crore of liabilities were fluctuating or floating. Please, friends, please mute yourself. Who is unmute? Huh? Please mute yourself, friends. Please don't unmute anyone. Kindly. Okay. So I have 100 crore, let us say, deposits, and 100 crore of deposit have been invested to give out 100 crores of loans. These loans are at fixed rate of interest. So it is at 10%. How my liabilities, my deposits are on floating rate of interest, and I've probably given out something like 8% on my deposits. What is my NII? 10% minus 2%? My 8%? 2%? Now, assuming that the interest rate increased by, say, 1%. Now, my 100 crore loans were at fixed rate of interest. So I continue to earn 10% on my loans and advances. But my liabilities, 100 crore of liabilities, were fluctuating and floating. So if the interest rate increased by 1%, I will have to pay, it will be now 9%. I will pay 9% on the deposit. So when earlier I was having NII of 2%, my NII declines to 1%. So 1% decrease in my interest income. Now, I hope interest rate risk is clear. How does it impact? Two ways. it impacts the NII, net interest income, and number two, it impacts the market value of the equity or the net worth through the changes in the value of assets and the liabilities. Commodity risk. Banks are not allowed to trade in commodity, so that is not getting impacted. Forex risk. So there is a possibility of losing money through unfavorable movement in the exchange rates. The sources of this is open forex position. When a dealer keeps open forex position. The counterparty risk, which is there, so RBI mandates a maximum open position limit. So whenever there is a financial transaction denominated in the currency other than the domestic currency of the country, then there will be forex risk there. Next, there is equity price risk. Now, these are all parts of market risk, friends. They are all parts of your market risk. What is equity price risk? So banks do invest in equity shares or some kind of investment that they have, and that's held in the trading book of the bank. So whenever there is a fluctuation of the stock price, it will impact the value of the investment. So this is your equity price risk. Now, another thing is liquidity risk. Whenever we talk about liquidity, we all can relate to it because we all face something called cash crunch. So whenever there is an inflow-outflow mismatch, there will be liquidity risk. So risk arising from funding of long-term assets by short-term liabilities, that is deposits, either they are due sooner or before full payment and realization of assets, then there is an asset liability mismatch. ALM is what is my liquidity risk. So whether it is like, for example, NBFCs, so they were borrowing on short term from the money market, from the mutual fund, the NBFCs were borrowing and they were lending to infrastructure projects on long term. And they were rolling over their short term liability. So there came a point of time when they suffered the asset liability mismatch. So that was what your liquidity risk. Inability to bring in requisite cash inflows to meet your cash outflow obligation. So either your assets becomes untradeable, they cannot be converted into cash, or your borrower defaults. So the money does not come in and there are unexpected outflows. So there are large unexpected withdrawals. Any of your bank guarantee that you have issued that have actually been crystallized in vogue. So any kind of cash crunch leads to your liquidity risk. Now, liquidity risk is primarily of three types. One, funding risk. Two, call risk. Three, time risk. What is funding risk? Non-funding of financial obligations or unanticipated withdrawals. Something we said run on the bank. So I suddenly face unanticipated a huge withdrawal of my deposits. My fixed deposit was for 5 years and the customer says after 1 year that I want to prematurely withdraw my fixed deposit. This is funding risk. So suddenly you have the liability on fixed deposit that you are supposed to pay. Let us say 10 crore FD was there. You are thinking, iska to due date will be after 5 years. The customer comes in and asks me today that he wants the money back. So now I have to pay 10 crore. I don't have the money to pay these 10 crore. I thought it will come after 5 years. Funding risk. What is call risk? crystallized contingent liability. So any of my letter of credit or bank guarantee, these are all contingent. They are not actual liabilities. They will be due on the happening of certain events. So for example, a bank guarantee of 5 crore gets invoked, LC gets devolved. So it becomes my actual liability. Now the bank was not expecting such a thing to happen. But now I have to pay 5 crore in the same way. It is called call risk. What is time risk? The risk of non-payment of contractual obligation or non-receipt of my funds on due date of loan. If some big amount becomes NPA, the money that I was expecting, it will come on such and such due date. It does not come. And I have liability standing to pay. It is called time risk. Now, just to give an example, live example. This is Northern Rock. Primarily, Northern Rock Building Society was a British bank. Northern Rock was a building society set up in 1965. Later, it became one of the prominent retail and mortgage lenders in the UK. The bank got failed. The bank's failure can be traced down to two things: excessive funding of long-term assets using short-term finance. Excessive funding of long-term assets using short-term financing. The same way in India, NBFC are getting failed. Two, sudden loss of market confidence. Northern Rock was the first run on a UK bank in 140 years. The government announced guaranteeing all the deposits of the bank to avoid insolvency and contagion impact. Now, next is your operational risk. So now we come to non-financial risk. So first one, very important, is your operational risk. So at some point of time, this was never discussed. It was in Basel II that the first time people thought about taking, about operational risk. What is operational risk? Possibility of loss resulting from inadequate or failed what? Processes, people, system, external events. Four things. Processes, there is some issue with the process to maker checker. Process is not there. People, there is an internal external fraud. System, there is a power failure. There is a virus attack. Any kind of system failure. There is no electricity in the branch for many hours. Or some external event like earthquake, fire, vandalism, any kind of thing, anything that occurs in my day-to-day operational activity. Cybersecurity, fraud, third-party risk, internal fraud, business disruption. So as per Basel, operational risk includes your legal risk, but excludes your reputational or strategic risk. This is as per Basel definition. A lot of time it is debated. There is no logic to why Basel has excluded these two risks. But a lot of times it is asked, what is excluded of operational risk? So reputational risk and strategic risk is excluded from your operational risk. Now, one of the biggest example of my operational risk is Nirav Modi, Punjab National Bank fraud. So it was a case of operational risk. With the LOU that was issued was not rooted to the core banking system, where the person who was to be transferred every 5 years was not transferred. There was a failure as far as the operational risk was concerned. So now banks are very, very much, involved in what is operational risk, how to measure operational risk, how to mitigate this operational risk. So what are the other non-financial risks? We have something called reputational risk, which is possible damage to reputation. We have compliance, legal risk, where there is non-compliance with the law, the rules, the regulations, any kind of ethical standard, any kind of non-compliance to that. Strategic risk. Risk matlab, strategic matlab, bank has had a business strategy. I'm going to expand my branches in the rural areas. That strategy fails. And because of that, the bank faces some loss. So whenever there is a business strategy that fails, that may lead to strategic risk. Technological risk to some extent is a part of your operational risk. Some kind of technical system, cyber security fraud. Now, another example I'm giving you. Husted Bank. It was the 35th largest German bank that collapsed in 1974. And due to its collapse, Basel came into existence. Husted Bank faced huge forex risk. The forex exposure was 80 times its exposure limit due to adverse forex movement. In June 1974, the losses amounted to 470 million Dutch mark. While bank had asset of only 1 billion Dutch mark, the liability amounted to 2.2 billion DM. The audit was conducted and management was forced to close its forex open position. The regulator suspended operation of insolvent Husted Bank on 26 June 1974 at 3:30 p.m. German time. While the bank could close position in some jurisdiction, it could not close other jurisdiction due to time zone difference. However, it also led to failure in some other banks, counterparty, which had released Dutch marks payment at 10:30 a.m. New York time, but did not receive US dollar payment. The risk was also termed as settlement risk. When one party delivers its forex contract, but the counterparty fails to deliver the same, mainly due to suspension of operations and time lag. It was also an example of operational risk. It highlighted a need for uniform banking regulations, cross-border cooperations, risk-based capital, and addressing a systemic risk. What is systemic risk? Risk of individual banks' failure can cause the collapse of entire banking system due to higher interconnectedness, mutual lending, and payment delays. It led to the setting up of Basel Accord and other reforms such as the deposit insurance protection and RTGS, etc. Now we have talked about systemic risk. This is very important. This is not to be confused with systematic risk. This is systemic risk. What is systemic risk? So in other words, it is called ripple effect, domino effect. Yeah. If we talk about COVID, another word, I don't know how many of you have seen the movie called Contagion effect, which spreads very fast. Why? It spreads very fast in the financial sector. This is very inherent. Inherent is the interdependence. So banks are not working in silos. Whenever there was in 2007-8 global financial crisis, they were not, banks were not working in silos. Something happened in US, impacted Europe. So what is systematic risk? Systemic risk. It is a failure or collapse of the entire banking system. And why does it happen? Because of high interdependence relations. So a major bank being in trouble, more banks being in trouble. They have lent to each other. So banks have lent to NBFCs. NBFCs borrowed money from banks. We have mutual funds. So all are interdependent. My borrower has taken loan from several banks. So if my borrower defaults, many other banks will be in the same situation. So what is happening? This is called systemic risk, domino effect, ripple effect, like we have seen in toys. One toy falls, the rest of them fall. Friends, to understand the implication of systemic risk, ripple effect, please see a movie on Netflix, Bad Boy Billionaire. When one big loan defaults, big loan account defaults, entire banking industry, it gives a ripple effect in the banking industry. Bad Boy Billionaire, please see this movie on the Netflix. You will understand the contagion effect, ripple effect, domino effect. Now we have understood what are the various or the major risks that banks faced, financial and non-financial. So why risk management? Sometimes, and there must be something common in these names. Can you guess what is common in these names? Yes, Yes Bank, PMC, DHFL, Lakshmi Vilas, ILFS. So banks, these are all the financial institutions that matter. So they are all bad banks. They have been the cause of bank failure. So this is exactly where we need risk management today. And we have so much trust on the risk management. Risk management ensures that the banks remain solvent and financially stable, ensuring adequacy of capital availability and loss potential can be controlled to ensure business continuity. Banks are too big to fail. Banks should not fail. So today you have a concept called systematically important banks, SIB. 3 banks, State Bank of India, ICICI Bank, HDFC Bank. These have been identified as systematically important banks. That is, they are too big to fail. So whatever are the best norms for the rest of the commercial banks, for these 3 banks, there will be some more stringent norms. Because banks are not supposed to fail. Why? Because they are dealing with public money. So for this, we need to know where the risk is. How much is the risk? How to manage the risk? How much capital I need? Why do we need capital? That is a question for absorbing my losses. There is a loss absorption capacity of the capital. So how much capital should I need to absorb my losses? Well-managed banks can help risk and help bank attain higher returns, minimize the chances of loss and avoid bankruptcy. So banks are dealing with public money. Consumer confidence is the key aspect. So 2 very important things that Reserve Bank of India talks about the way are PCA and SIB. PCA and SIB. Prompt corrective action. Bank said they forgot, it is not everything, it happens, chalta hai. then RBI steps in. RBI says you have to do early intervention, timely intervention. You have to step in at the right time and prevent the bank from getting into ICU stage. And there should be something called systematically important banks. So 3 domestic systematically important banks are identified. They are too big to fail. So these are the 2 things which are there, which are part of our risk management, in which Reserve Bank came up. So when we adopt risk management procedures, what are the advantages to the bank? Successful risk management ensures steady growth of the bank, adequate capitalization, confidence to do business. It gives business drivers and support, and it helps banks to comply, to maintain policy, regulatory, and legal compliance. Now, what is the process of risk management? So, we know what is risk. We know why it is needed. What is the process? Simple. पहले देखना है कहाँ है risk. When you want to solve a problem, you need to identify it first. Where is the risk? Once you identify, you analyze, assess the risk. कितना है, कितना ज़्यादा है. Third, you find out ways to mitigate the risk. And last, you need to monitor and control. So whatever were my strategies, identifying means ascertaining the cause of this, the source of the problem, what event caused. Was it an internal event, fraud, unauthorized access, or was it an external event, a pandemic, a theft, a loss by fire, or something else? Once I know the cause, I need to find out what they are, how to analyze it, how to assess it. So when I talk about analyzing and assessing, we are talking about the probability of default. What are the chances of that particular event happening and severity given the default? For example, I say in my branch there are frauds that are happening. Now the probability of default happening, let us say once a year, once a month, or once in 6 months. This is my probability of default. The chance of that event, that fraud happening, is once a month, once a year, or once in 6 months. Now I know the event. Let's say it happens. Then what is the severity? What will be my impact? So let us say our one fraud, it impacts 50,000 rupees. Or is it 5 lakh rupees? Or is it 50 crore rupees? That is a severity. So based on this particular thing, what I need to decide, I need to understand what will be my risk mitigation strategy. So based upon this high probability, high severity, I will have a different strategy. A low probability, low severity, I will have a different strategy. So I grade it. Based on that, I decide my risk mitigation strategy. What I can do. Like my 4 aspects in this process, there are only 4 risk mitigation strategies. Either I can accept the risk. When I can accept the risk, it is too small. There is low probability. There is low probability of it happening. There is low severity. हो भी जाएगा तो बहुत ज्यादा नुकसान नहीं होगा. ठीक है, जब होगा तब देखेंगे. So that is accepting. Second, I can avoid the risk. Too high a probability of it happening, too huge a loss. जम्मू एंड कश्मीर में टेररिस्ट अटैक होने के चांसेस हैं. So, and I open a branch there, suddenly it's quite sure there's going to be a terrorist attack there. So I may just avoid that situation. I may not open the branch. Let's assume. So too much risk to take, I avoid the risk. Or I can control or reduce the risk. So I know this risk is going to happen. I have a double maker checker there. Or I may take some extra security. If I know this loan is risky, I may take some extra security, some extra precaution. So I am reducing the risk. The fourth way to mitigate is to share, transfer, or outsource. So for example, the recovery aspect. Now I know my staff strength. I cannot recover the loan, so I outsource it. ATM, I outsource it. So I'm giving it to somebody, or I share it, transfer it. I ensure, for example, my house, my branch. What should I do? So there may be loss of fire or something happening. I ensure, I take insurance for my house. I take burglary insurance. I take fire insurance. I take life insurance. What I am doing? I am transferring risk. So the risk mitigation strategies are for either you accept, avoid, control, or share. Based on what? What is the probability of that happening? And if it happens, what is the impact? Based on this grid, I will decide upon any of the strategies and or both of the strategies. Once a decision has been made, I need to monitor. I need to report. If there are exceptions, I need to report it to the as per the hierarchy laid down. So friends, this was all I wanted to discuss about the risk